The world's biggest bond fund manager, Pimco, says we're heading into a time of fewer bailouts, and that means it's actually a good time to buy up bank debt. Mark Kiesel is Pimco's global head of corporate bonds, and he joins us this morning from Newport Beach, California. So, Mark, usually less risk doesn't mean as much reward. Why is that not the case from your perspective?
Well, I think basically you've seen a large move in credit so far this year, and so you have to be more selective in this new normal that Pimco talks about. We're in a market right now with a lot of uncertainty and risk. We're seeing less growth in developed countries, faster growth in emerging countries, and we're seeing re-regulation and deleveraging of the private sector. So you have to be, from a credit perspective, much more selective today.
And being much more selective, when you're looking at the financial space, what does that lead you towards?
Well, we like U.S. banks from basically a fundamental, technical, and valuation perspective. Fundamentally, the U.S. banks have built up the most capital. If you look at 2 years ago, Tier 1 capital ratios were 6% for U.S. banks. Today, they're 9%. A lot of that has been due to external capital raising over the last 18 months. Technically, the U.S. banks have a lot less supply to issue going forward relative to the European and UK banks. That's because they're not making as many loans. They're sitting on a lot of deposits. And then finally, when you look at valuations, the U.S. banks are yielding about 5%. And they have the widest negative basis in the market. So for all three of those reasons, the U.S. banks look most attractive globally.
Well, looking at the global perspective, I want to ask you about your interest in emerging markets. You point out that that corporate bonds in emerging markets is at, what, $650 billion? They've seen growth of 15 to 20% over the past few years. There's still growth there, you think. Where do you direct your investment there? Which companies, which countries?
Well, Pimco has 37 analysts and 25 portfolio managers all over the globe dedicated towards credit, and we have been increasing our exposure in emerging market corporates, specifically in countries like Russia and Brazil. In Russia, we like companies that are focused on energy and pipeline. Russia has some of the largest energy resources in the world. In fact, last week I was just over there meeting with government officials. In Brazil, we like companies like Petrobras, which just raised $70 billion of equity last week, as well as Gerdau, which came with a new 10-year deal last week, which priced just under 6%, as well as one of the lowest cost iron ore producers in the world, Vale, which long bonds trade at 6%. So these emerging market companies have great resources, low cost of production, and yet the yields are 5 to 6%, which is basically about 1 to 1.5% more than what a similarly rated company would be in the United States or Europe. So you're getting a significant yield premium on these companies, yet you're getting better assets and value.
So you get the benefits of quasi-sovereign involvement with the upside of the corporate growth, if the sovereigns stay in there. Thank you so much for giving us that snapshot. I appreciate it, Mark.